warm welcome to everyone and thank you for joining this Hardman & Co Investor Forum. My name is Keith Hiscock and I'm the Chief Executive of Hardman & Co. These forums give investors the chance to hear a company's investment case and question the management. So we come to our final presenter, who is Savvas Savouri. Savvas is the Chief Economist at Toscafund, which is a leading hedge fund. Savvas trained as an economist at the London School of Economics and has been in the city since 1991. The last 12 years of which have been spent at Tosca. He's well known for having occasionally interesting and differentiated views. Savvas, over to you.
Thank you very much, Keith, and I had the pleasure of working with you. I'm going to deal entirely with economics, focus on the UK, and I'm not desensitized to the fact that this virus has wrought some very serious medical and monetary harm to families across the UK. Having said that, I've got to deal in aggregates. And the reality is that in aggregate, the UK has seen, or rather the households across the UK have in total seen a huge increase in savings because as their incomes have for the most part been underwritten by furlough schemes, in other cases by the boost to activity because large tracts of the economy have actually been stimulated by the behavioural changes that COVID has wrought. So you've got a positive there and also a restriction on what we can spend. So we estimate that by the time this third lockdown comes to an end, UK households would have accumulated something in the region of 300 billion of excess savings. To put into context, these numbers shouldn't be seen as controversial. The Bank of England Chief Economist Andy Haldane mentioned that in an article that he gave, or an interview he gave to the Mail on Sunday, that he thought that there was 100 billion of excess savings at the end of the second lockdown. So we're assuming that the run rate continues. Now, let me make perfectly clear, I'm not evangelizing about the UK. I honestly think that the UK economy will come out of this crisis incredibly strongly and robustly. And I'll make two caveats to that. One is that enforced saving that we're seeing in the UK has been in large part denied incomes across large tracts of Eurozone Club Med. Just imagine the hollowed out incomes across the Mediterranean from Portugal down to Spain, into France, Italy, Greece, Croatia, Bulgaria, Cyprus, Malta, economies that rely upon tourism for, in many cases, about a quarter of direct employment and a quarter of GDP, have actually lost not simply 1 year, last year's hard currency earnings, but will most likely lose this year's as well. And these are countries that came into this crisis with, in many ways, weakened fundamental economies in very much the same way that COVID has been most dangerous to human beings with pre-existing conditions. So the same applies to economies. So comparatively speaking, the views I'm expressing for the UK should not be interpreted as being views that can be extended to Europe. In many ways, the prognosis for Club Med Eurozone, bear in mind that includes a number of large Eurozone economies because you've got France, Italy, and Spain, that will basically have ramifications for Northern Europe. It's true that Germans and Swedes and Dutch not traveling south on holiday have denied Southern Europe incomes, but those incomes in Southern Europe have been recycled back to Northern Europe because the Southern Europeans will have surpluses in tourism, but deficits in trade because they go and buy consumer and capital goods made in Sweden and Germany and Holland and Belgium. So that will ricochet backwards and forwards. In the UK, we are net travellers. We have a deficit of £40 billion a year in tourism. And in many cases, that money has seen itself already in the form of staycationing. Another point I need to make, a second caveat. So the first caveat is the UK is unique in the sense that, and I'm not being insensitive in saying this, the UK economy has had, by and large, a good crisis in terms of its fundamentals. So the second thing is that had COVID struck in any year other than 2020, any year between 2008 and 2019, there were forces in the UK that would have meant that my prognosis would have been much different. Think about 2008, the crisis that we're seeing today, we've seen for almost a year now, has been compared with 2008. They're incomparable. 2008 was a crisis which was profoundly fundamental and avoidable. You had over-leveraged banks, property prices were overinflated, the pound was too strong. You had lots and lots of a confluence of forces that created the 2007, 2008, 2009 crisis. Quantitative easing followed. Thereafter, what happened was that you had an economy in the UK that between 2008 and arguably 2013, 2014 had underlying problems. Unemployment was not as it was coming into this crisis, barely 4%. It was hovering 8% until really 2013, 14. Gilt yields had responded badly to the banking failure. So with gilt yields, which came into this crisis close to zero in real terms, back in the post-2008 period up to 2014, where gilt yields were 5%. You also had other issues over that period. You had inflation that had responded badly. So between 2008 and 2013, 2014, the UK economy could never have withstood the COVID crisis. Thereafter, unemployment began to fall, the economy began to recover, gilt yields began to fall. You had banks were much more macroprudential because the Bank of England demanded they were. But then what happened in 2015, 16 was that you had the shock election of David Cameron without unencumbered by the Lib Dems. That then triggered uncertainty concerning an EU referendum. Then comes June 2016, and we have the result that we know shocked capital markets in the UK. And then from 2016 until 2019, the UK was beset, despite having unemployment that was historically practically zero, because under 4% unemployment is seen by most economists as being zero in to all intents and purposes. Anything below 3.8 starts to create problems with wage inflation. So what you had in 2016, 17, 18, and 19 was a political crisis in the UK. Had the COVID crisis struck in February, March of 2019, February, March of 2018, 2017, Parliament was in crisis. You had a Tory party that had to deal with an ever decreasing minority as MPs defected. Come the 12th of December of 2019, that political uncertainty was shockingly ended, and we entered 2020 expecting the UK to really deal with Brexit, but also deal with it in a way that you had a coherent political voice in Westminster. So the point I need to emphasize is that had this crisis struck the UK between 2008 and 2019, it would not be in a position that it is today to deal with it so robustly, emerging from it. And also the way that this crisis has struck the UK is unique to the UK. You can't extrapolate conclusions for the UK into any part of Europe, including Northern Europe, including Germany, this big mercantilist economy that really needs a healthy Southern Europe to buy its consumer, to buy its capital goods and consumer goods. Just to give you an idea, this is sort of these bullet points attempt to really to bring home in just a handful of ways why this is not 208. In fact, it's not any proof. I'm into my 30th year of working in commercial finance. So I've studied the UK economy since I was 17. I've taught economics and I've practiced economics in commercial finance. No two recessions are the same. This is technically a recession. You can't deny that because GDP has been falling and there's been a hit to the labor market. The issue here is that this is existential. This is not a structural recession that we had in the 70s and into the 80s. It's not a housing-led recession that we had in 89. Again, like 208, perfectly avoidable, but brought about because we had really politically reckless hands on the tiller of the housing market. The UK now is really much managed out of Threadneedle Street. The Bank of England is back in good governorial hands. I think whatever you think about Andrew Bailey as the FCA, he's been a good central bank governor. Back in 2008, we were lucky we had Mervyn King. But also we've got a very good chancellor this time around. He may prove me wrong, but thus far, Rishi Sunak has been exceptional. I think we're lucky again. A month before this crisis struck, he was effectively thrust into number 11 because Javid was kicked out. I don't think Javid would have been remotely as good a chancellor as Sunak has proven. Imagine again just how the good fortune of the UK was that we haven't got McDonnell or this sort of had the election gone differently, we would have had what would have been called a government of national union. Imagine dealing with this crisis, however incompetent or competent you think this Tory government has been. Imagine a government of national unity where you had Labour alongside Plaid Cymru with the SNP, Lib Dems, all pulling in different directions. You'd have seen effectively what we've seen unfolding across the European Union. So just give you an idea, this is the bars reflect since 2000 savings at the household level. These are official figures from the ONS. The red line is unemployment. So you get the idea that when the 08 crisis happened, you had a big increase in unemployment, joblessness because of the shocks to the financial sector, a material increase in household savings ratios because of the impact or the hit to confidence, jobs confidence. Then we had the referendum. What we've had recently then are these big blowouts in forced saving, which cumulatively will amount to about £1/3 of £1 trillion of enforced household savings. It won't all go into GDP, goods and services. It will go into asset prices, property prices. This goes back to my point about this being a really unusual recession, in as much as the residential market hasn't been boosted because of stamp duty being suspended. It's been helped by that, but really it's because householders are sitting on, in aggregate, there are exceptions sadly, sitting on considerable amounts of enforced savings, which sitting at home with their computers, they can look around for potential house moves, property moves. And that really brings me to another point. So one of the reasons why I've got a very strong conviction that unemployment will spike but then come down very quickly is because the UK is unique. Let me sort of spend a moment with these graphics. The red line on the left is a reflection on the number of workers involved in go-to old consumer sectors, pubs, restaurants, bars, even indeed gyms, because people increasingly began to use their homes as their sort of gyms with Peloton. The blue line shows the number of workers across the UK in come-to consumer sectors. Because as much as we think that the cloud is a destroyer of jobs, ordering something from the clouds still has to be delivered with boots on the ground. In fact, what you see here is that from 2013, the number of workers in come-to consumer grew and grew and grew. Much more labor intensive to think about the time when the FTSE 250 had 4 dairy companies, because delivery that we know today, sort of this bespoke time-slotted delivery of everything, used to happen just from milk and bread. And we had Dairy Crest, we had Express, we had Unigate, Robert Wiseman. Well, this time round, what used to be a very sort of narrow product, sort of unrefined delivery system has now been very much refined, and it's very labor intensive. The graph on the right shows in red the growth rate, the anemic growth rate in retailing in the UK, if it's measured by GoTo. So these are the problem with the red line is that it picked up the death of the high street and shopping centres. The blue line, by contrast, which matches the blue line on the left, is the growth, the compound growth rate of 15% in internet retailing. Things come into your door, and to repeat, incredibly labour intensive, from the warehousing all the way through the supply chain to your front door. Having a tin of baked beans delivered to your front door involves more labour being employed than you going to a grocer's, to going to Sainsbury's or Aldi to pick up those beans. Again, that's the myth that has been played out ad nauseum about technology destroying jobs. It does not destroy jobs. It creates a completely new industry makeup, which is even more labour intensive than what it's replacing. Am I arguing that these jobs are high value added? No, of course not. But the jobs being lost here are, for the most part, of a nature that the skills can be transferred to here. Okay, like it or not, it's a like for like job. This is not job disruption that we saw before, where you had highly skilled manual men in shipyards and steel mills and coal mines losing their work and having no alternative, often being, invariably being the heads of households, the only earner, invariably in regions for which that industry was the core driver of secondary and tertiary sectors. This time around, not one part of the UK has been in any way disproportionately hit by this crisis, because there are pubs and bars and restaurants and leisure centres and arenas all over the country. This is a thin, widespread shock that will bounce back quickly. So returning back to the graph on the right, just before this crisis struck, it appeared that the rate of growth in internet penetration, I call it peak RIP. It appeared in November of 2019, December of 2019, January, indeed February of 2020, that the growth rate of the internet in terms of invading retail spending had peaked, peak retail internet penetration. And then this crisis struck, and you saw the growth rate of what we consume through the internet going up. Now, the UK is unique in this regard. What you have on the left is the same line that we saw before, captured by the growth rate. So what this graph does, it shows you how much of the internet accounts for retailing. Now, it appeared that we were peaking at 20% at the close of last year. Then you have this huge spike here. Almost certainly we're going to be here. Look at the rest of Europe. Look at Southern Europe. Even the US, the home of Amazon, has less pervasive internet penetration than the UK does. Why does this matter? It matters because some of the activity that we were denied in go-to retailing has been captured in this very labor intensive spike in come-to retailing. And again, to repeat, as much as we've seen workers lose their jobs, we've seen a huge increase of bifurcation in the UK economy in the form of dramatic job creation across the supply chains that feed this growth here. Now, that's been absent across Europe. So not only these Southern European, these Mediterranean club-med Euro economies been denied tourism from the UK and from Sweden, from Germany. They haven't had the internal mechanism to capture lost consumption as households have been locked down. And also, as we know, sadly, that whereas the Chancellor in the UK was able to respond very quickly with a furlough scheme and some business support schemes, because of this, the singularity of the European Union and the sluggishness of moving 27 economies as one, you haven't seen that support across Europe. And I don't think that we have yet seen just how damning this crisis has been fundamentally for the large tracts of the Eurozone. What the Eurozone does not need at the moment is to have matters made worse. And the way that things are going, just as in 2008, the Bank of England acted very quickly, but the ECB acted slowly. Bank of England cut interest rates dramatically, engaged in QE back in 2008. It took years before the ECB did both of those things. And if you act too late, it's too late. Just moving through a few other themes here. The red line here is old-fashioned finance in the UK, sort of moving sideways. it'll go down. But the blue line is the way that you can't have e-commerce without fintech. And the UK has enjoyed a huge increase in employment in fintech. This is the number of workers in fintech in the UK, again, using the official data. And this is a combined. Going forward, I have no doubt that in shifting even more of us into e-commerce and e-finance, job creation will be driven all the more. And as these countries across Europe have to embrace e-commerce and e-finance, they're going to look to London to provide the software to drive that. So these are, again, this is a going back to this sort of £1/3 of £1 trillion of excess saving in the UK that I can't emphasize enough is going to be the catalyst, the oil that fuels the UK recovery to create, as I mentioned, what effectively will be a short, sharp spike in unemployment. My PhD is in labour economics. And as such, I studied it firsthand, really, when you had a UK economy in the 80s, which saw GDP begin to recover in 81, but unemployment not peak until 1985-6. And that was because of structural mismatches in the UK, which do not exist today because of the painful supply side reforms that were embarked upon in the 1980s, continued into the 1990s, and have continued even more into this millennium. So just to summarize and to repeat, if you can use the word luck in any context dealing with a pandemic, I'll use it here in the sense that the UK was very lucky. It was struck by this cursed virus in 2020 and not any year before then, back to 2008 and before. We're lucky that we're being hit by in the UK with a strong alternative economy in many ways. The internet and all of its affiliates is, to me, as an entirely new economy which creates jobs. If you look at the data from the Recruitment and the Employment Confederation, they show you just how bifurcated the UK is in terms of incredible demand to recruit in sectors that have been expanding because of this pandemic, and of course sectors that have been locked down, seeing a collapse in recruitment. We've also seen, as we know, in the region of 1.4 million Europeans who were hitherto in the UK returning back to Poland and Lithuania and Estonia and Bulgaria and France and Greece. The idea that they won't come back is absurd. They will come back once the jobs that they formerly did are once again available to them. And that's the thing, is that we're not avoiding going to destinations that involve leisure or recreation. We've been denied the access to these things. And when the access is allowed us again, we're going to return using the saving that we have accumulated. And the jobs that were once there are going to be returned. This is not like shipyards closing down or steel mills closing down. If you lock down a coal mine, it's permanent. It was because of a structural change in the global landscape. Closing down a stadium, an arena, a restaurant, or a bar is purely temporary. So this recession is entirely frictional and not structural. So quite a lot going on there. I'm more than happy to take questions, and thank you for your time.
Okay, Savvas, thank you very much indeed. I think the most popular question is, if you were Rishi, what would you be doing now? Because obviously people are thinking about tax rises, they're thinking obviously about employment, which we've covered, but the structural changes in the way the workforce is employed, which is what you partly addressed. And I think it moves on into other questions we've been having on, what does this mean for offices? What does it mean for shopping centres? What does it mean for all the structural side of the economy that has probably been at a tipping point now that we obviously didn't realise it was going to happen. So what's your general take? If you're Rishi now and you've got a 2 or 3 year view, what are you going to do?
Well, that's a very good, you make the point just now about a 2 or 3 year view. This country will not face an election until December 2024. So this is really a great time to be doing adventurous, revolutionary fiscal changes. And I have no doubt that he will respond to the disequity or inequality in taxation, corporate taxation. So there will be an Amazon tax, or call it a sales tax on the internet. It will be absorbed into margins. It won't be inflationary. I have no doubt that he will announce at some point very soon a very generous car scrappage scheme to kickstart those car factories that are very heavily centred in the Midlands and the northwest and northeast of England. So, and in terms of how he funds it, let's be perfectly honest here. The UK has gone from being a bank that would pay its depositors an interest rate, which is positive, to being a safety deposit vault. Gilt yields in real terms are negative. The world is giving us their money, to say, and asking in return for less than they gave us. It's that form of protection. So he can spend effectively money that isn't being magically produced by a money tree, but global savings looking to deploy out of dollars. Why is that unique? Because it's the first time in my experience that gilt yields in the UK have been negative in real terms, imitating Switzerland. So car scrappage scheme, both economically sensible and environmentally sensible, sales tax, eminently sensible. Otherwise, the economy has enough dry tinder not to need to be overstimulated. I haven't even touched upon the fact that I have no doubt, I'm categorical on this, that at some point between now and the end of the year, the pound will have gapped up to 1 point, as capital markets realise how fraught matters are across the Eurozone, and as the ECB is expected to cut rates below zero, the pound will start to move from where it is against the euro, 114 to 130, which is disinflationary. It will move up against the dollar as well, as capital arrives into the UK, responding to its favourable status. So, yes, the Chancellor can mess things up. No, he has shown no signs of being in any way negligent thus far.
So we've had another question, just to reiterate, do you consider the current levels of debt in the country, which is corporate debt, household debt, government debt, does it worry you to any extent that the economy is out of balance?
Well, again, if the question is am I concerned about quantitative easing? Let's do the counterfactual. Suppose that the Bank of England did not perform quantitative easing in 2008. Let's be honest. Quantitative easing happened back in 2008, and it stopped in 2013. It was restarted, I think, wrongly by Mark Carney after the referendum result. I think Mark Carney had a sort of a hero syndrome. He got the Brexit thing wrong. We voted to leave. He then cuts interest rates and embarks on QE for no reason. The economy didn't show any signs of responding badly to that. This QE program that we've restarted has been dramatic, but incredibly sensible. So at the moment, the Bank of England is sitting on about £750 billion worth of accumulated gilts, principally. Am I concerned about the exit from that? Am I concerned about a taper tantrum? No, because in many ways, the global appetite for gilts is such that the Bank of England, like it or not, since it began buying gilts, the Bank of England has created a huge book profit for us because it bought gilts at far higher yields. These gilts have been maturing. The Bank of England has basically gifted the maturing gilts to the Treasury to write them off. It's been receiving coupons on the gilts, which has been gifted to the Treasury or the Exchequer. This is not the QE that we saw in Japan or in the US, where the money left the country. It went in search of yield. The QE performed in the UK stayed within the UK, recycled, recapitalized the UK. So it often frustrates me a lot when QE programs are compared as if they're equivalents. They're different. The Japanese QE program and the American QE program, the ECB QE program, were very unique in their own ways, and so too was the UK one. And to repeat, in the UK, money never left. With the ECB, the QE money went into peripheral Europe. It went into Poland and Romania and Bulgaria, into Sweden. So I'm not being blithe about the scale of the QE. I'm just grateful it happened. And think about the alternative that had it not happened, we'd be eating dirt now.
So we've got a third of a trillion of excess savings, roughly. I think that's what you mentioned. So that can either be spent or it can be invested. What do you think the profile will look like as the economy recovers, employment improves, and people's spending patterns change? And then I want to link that back into a number of questions about, is this reflected in the UK market, stock market? No. So we need to explore that. And we also need to look at possibly why has the US stock market done so much better than the UK market? What is it that investors here are missing in the presentation you've just given? Because it's very compelling on the numbers.
Well, let's think about the composition of the markets. The Americans have got this sort of concentration of tech stocks. I wouldn't put Bitcoin or Tesla into that category, but they've got the FANGs that have done rather well fundamentally. And our job in the UK is to capture some of that success through a sales tax. There's no way that Amazon are going to leave the country when we start taxing them. They'll simply absorb it into their incredibly high net margins. The problem with the UK is that much of this goes back to a point you made before. Large tracts of the UK have a property bias. And the narrative from journalists has been that we're going to end up having working from home as the new norm. And let me make one observation. Journalists are very good at telling you what's happening when they don't know what's happening. You think that, consider the Schroders building. The Schroders building, that huge new building that Schroders occupy down by London Wall, it changed hands in the middle of the pandemic at a yield of 3.8%. Okay, no one's in it practically. My good mate Andy Bruff goes to work, but he's in a big temple. Global appetite. You ask any agent looking at real estate in the UK, resi or commercial, the appetite to be an investor is huge. Ask an agent to find you floor space in London, City of London Prime. They'll say, can't find it, bid only. And because the tech giants, they're still paying their rent. Let's put into context. Property rents are about less than 1/10 of a business firm's costs, fraction. They can still pay rent even if their workers are at home. And at some point, very soon, those workers who are at home are going to return, because that's the nature of competitive economies. You don't want to be at home. Management will start to make a very powerful impression that workers who are staying at home may need to reconsider their contracts in terms of contract, become consultants or not full-time employees, with all the consequences to the access to credit. So I don't think working from home is anything other than a short-term issue. And we, just full disclosure, we as a firm here, we've got a very sizable investment in IWG, formerly Regis. We've got a very significant affiliation with Regional REIT, which is an office business. So this is not mere conversation for us. We have skin in this game.
Look, thank you very much, Ian. I'm sorry we've run out of time, but there are more questions which we can probably handle another time. Thank you very much, Savvas. It's been terrific. I'm just going to hand back to Keith. Thank you.
Richard, Savvas, thank you very much for that. That concludes the 4 presentations. I'd like to thank our speakers and you, the audience, for attending this forum.